We just got the newest inflation report and it shook up markets because initially yesterday morning when the inflation report came out, it caused the stock market to boom. And then later on throughout the day, as investors and traders digested this information, we saw the stock market come back to earth. So what I want to do today is first go over what the inflation report said. And second, I want to go over what this inflation report means because the Federal Reserve Bank is going to be meeting later today and they're going to announce what they want to do in terms of interest rate hikes. And one of the factors they're going to be talking about is this inflation report. So let me start by talking about the inflation report because what it said is that between November 2021 and November 2022, our headline CPI inflation came in at 7.1%. Now, the 7.1% number is better than what was expected because economists expected this number to be 7.3%, and it's better than where we were last month. Because last month we got the October to October figures, which said that between October 2021 and October 2022, inflation rose by 7.7%. So while the 7.1% is better than where we were last month and is better than what economists expected, it's still extremely high because the 7.1% a year ago would have still been the highest inflation that we have seen since the early 1980s, and we are still closer to a record high inflation than we are to our target inflation. In June 2022, we hit our inflation high during this post-pandemic inflation period where we were at 9.1 inflation, and we're closer to that 9.1% than we are to our target inflation of 2%. So let me go over now a little bit deeper of the actual inflation data points so you can see where we're seeing the high inflation and where we're seeing the deflation. On the high end, what we've seen over the last 12 months is that butter prices have risen by 49.1%. Airfare prices have risen by 38%. Public transport prices have risen by 23.8%. And shelter prices, housing prices, I'm going to talk more about this in a minute, but shelter prices have risen by 7.1%. Now, on the negative deflationary side, we have beef and veal, which has fallen by 5.2% according to the data. Car rental prices have fallen by 6%. Television prices have fallen by 17%, and smartphone prices, according to this data, have fallen by 23.4% over the last year. Now, iPhone prices, from what I see, are still very expensive, so take that for what it's worth. Now, diving a little bit deeper to what this means for regular people, because according to the data, what it says is that regular people, households in America, are having to pay $396 a month more today to buy the regular things than they had to a year ago. And this is because, well, inflation. Now, if you read the reports, every report says that wage growth is strong, but it's not as strong as the inflationary growth. So we've seen wages grow over the last 12 months, but wages haven't grown enough to keep up with inflation. What does that mean? You got a raise, great. But if it's not as high as the inflation numbers, you're still effectively poorer now after your raise because of inflation. So that's what's going on with the inflation report. Now let me turn this to kind of what this means more on the analysis side. Now, of course, we cover all of this stuff when it's happening in terms of the economy, the stock market, real estate, crypto, and the global economy in Market Briefs, which is my free financial newsletter. If you haven't joined Market Briefs yet and you want to stay up to date on what's happening, when it's happening, it's a super easy to read email. You can read it in less than 5 minutes every morning. And the best part is it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. So in terms of what this means, the Federal Reserve Bank is working to bring inflation down, and they're also trying to not induce a recession. And the way that they're doing that primarily is through interest rates. The more they raise interest rates, the more it becomes expensive to spend because the Federal Reserve Bank wants to reduce demand because demand is one of the things that kind of influences prices. Now, to understand what that means, think of it this way. When the pandemic was happening, the Federal Reserve Bank was working to increase demand because we were facing a period of economic slowdown. We were facing a period where people weren't working, and we were facing a period where wages were falling. So to increase demand, the Fed created inflation. How did they do that? stimulus checks, unemployment checks. They were writing big checks to corporations, businesses, doing a bunch of just money printing, where we printed more money than ever and gave it to people and businesses. Now you had money, even though you weren't necessarily working, but it increased demand because now you had the ability to spend. Now when you were able to spend, this then created a boom in the economy. Well, now to fight inflation, the Fed wants to decrease this demand. How do you do that? By making things more expensive. And the way that the Fed can do that is by influencing interest rates. When you raise interest rates, it makes borrowing money more expensive, which effectively makes doing business more expensive. The easiest way to see that is in housing, because now when you raise interest rates and you want to buy a $500,000 home, well, it's going to cost you more money, even though the price of the home might not have changed because your mortgage costs have gone up to borrow the same amount of money. Now, the effect of that is you do see home prices fall because of higher interest rates, because less and less people could then afford a $500,000 home, which puts downward pressure on housing costs because demand falls. The price of anything really depends on supply and demand. When you have a higher supply, that also influences prices because higher supply pushes prices down. When you have low supply, it pushes the price of things up. When you have high demand, that pushes the price of things up. When you have low demand, that pushes the price of things down. So the factor that the Fed can work on right now is demand. And up through now, we still have had high demand for a lot of things because people still have money, and the Fed is working to decrease this demand. They're decreasing demand through raising interest rates. Now, I know this can get confusing, so you might want to watch this part again, but they're working to decrease demand by increasing interest rates, which makes business more expensive. And now the Fed has to decide how aggressive they want to be with raising interest rates, because raising interest rates decrease demand, which could induce a recession. Now, we have a lot of different opinions about what is going to come with a recession or not in the next year or 2 years. Treasury Secretary Janet Yellen just gave a talk yesterday where she said that she does not believe that we are going to enter a recession. She doesn't see any signs of a recession. Although the risks are there, she doesn't believe that we are going to face any sort of recession. Now, on the flip side, you have a number of banks that are preparing for a recession and who believe that we will enter a recession. I made a couple videos in the last 2 weeks talking about different banks and their opinions on a recession. Bank of America, Deutsche Bank, JP Morgan Chase Bank, all of them believe that we're going to be entering a recession, and they're all doing things to prepare themselves and their bank accounts, their investment accounts, because of the slowing economy. So this is where understanding now raising interest rates affect the economy. Now, even if the Fed never raised interest rates again, we're still going to have to pay the price for the higher interest rates, because the raising of interest rates has time. It's kind of like a lag effect, where it takes time for the higher interest rates to get absorbed into the economy. And this isn't just the housing market. This is the entire business industry. This is the price of everything, because businesses who operate on debt have to service their debt, meaning they have to pay their monthly payments. Well, businesses, unlike homeowners, don't get a 30-year fixed rate mortgage. Their debts readjust, meaning the interest rates change every few years. And if interest rates go up, well, that means the cost of your debt is also going to go up. And that's going to be something that we see over the coming years, because, even in just 2022 alone, we have seen interest rates more than double. So the cost of servicing these debts, as interest rates readjust over the coming 24 months, more and more businesses are going to face the cost of that. Our national debt doesn't have a 30-year fixed rate mortgage. It has adjustable rate mortgages. Some of them readjust in 5 years, some of them readjust in 2 years, some of them readjust in 1 year. So over the years, we're going to see more and more national debt get readjusted, and the cost of servicing our government debt is going to go up. Same with people. If you have credit card debt, well, your cost of servicing this debt will also go up. So now the Federal Reserve Bank is facing a dilemma. How aggressive do we want to be? Do we want to be very gung-ho aggressive and do whatever it takes to bring inflation down? Well, we don't know, because over the last month, the Fed has been saying that they don't want to be as aggressive as they were, and they want to start looking at the cumulative effect of interest rate hikes. Now, we'll talk more about this tomorrow once we know what the Federal Reserve Bank does. However, you also have to understand that the inflation problem hasn't gone away. Yes, it has cooled from its high, but it hasn't gone away. We're still closer to our inflationary highs than we are to our inflation target. And this is where inflation is going to continue to give pain to our economy, because the kind of general consensus now is that yes, consumers are struggling because they're not keeping up with their wages. However, the consensus is that consumers are okay because there's still $1.7 trillion of excess savings out today because of the pandemic stimulus programs. So unemployment checks, stimulus checks, there's still $1.7 trillion of this excess money that's floating around in our economy. And so, yes, people are struggling because of the higher prices, but because people still have this excess cash, they're still able to spend. Now, how are they spending? Are they using the cash in their bank account? Well, we're also seeing credit card debt rise at the fastest rate ever. We just got the third quarter credit card debt usage statistics, which said that last quarter, we saw credit card debt levels rise at the highest rate ever before. So people are still spending. Sure, maybe it's on a credit card, which isn't good for people, but on an economic level, that's good. So you can see how economists and personal wealth kind of have this discrepancy, because economists want to see people just spend money, even if that means you're going into debt to do that. Personal wealth is, I want to be able to afford things. I want to be able to invest my money. So there's a little bit of a discrepancy there. I'm trying to get you educated on how the system works. That way you can make better decisions with your money. But this is where understanding what economists are looking for, because they want people to spend. Now, if you look a little bit deeper, I talked about the housing costs risen by 7.1%. If you look around, the prices of homes today are many times higher than 7.1% than what the data says. The data says that home prices, shelter costs have grown by 7.1%. Now, many of you, whether you're a homeowner or a renter, have seen your housing costs grow significantly higher than 7.1%. And part of the reason is because the CPI data is kind of manipulated. And I've talked about this before, where the Bureau of Labor Statistics, when they look at our housing costs, they don't look at rent prices and home prices when determining shelter costs. What they look at is something called owner's equivalent rent. Now, what owner's equivalent rent is, it's where they then survey homeowners and they ask them, if you were to rent your home out, how much would you rent your home out for? And based off of those numbers, they then create owner's equivalent rent, which is one of the biggest portions of our CPI report. And this is why many times our CPI report can come out lower than the actual inflation that so many people feel, because many homeowners don't actually know what the fair market value of a rental is. So this is why many times people look at the CPI number of 7% or 8%, and then they say, wait, I feel like my grocery costs are way higher than that, or I feel like my monthly costs are way higher than the 7 or 8% that's reported. Well, the reason for that is because many times the way that the CPI is reported can influence what the CPI number is, which is sometimes different from what many people feel. So I want you to understand that, but then also understand that the pain for inflation hasn't gone away, and also the pain from rising interest rates has yet to be felt. So this is why you want to make sure that you are financially educated, and one, you understand what's happening, but also preparing for anything. That way you can take care of yourself, that way you can take care of your family, and that way you can take care of your community. And if you don't know what I mean by that, check out some of the financial education videos on my channel, where I talk about how to invest your money in the stock market, how to invest your money in real estate, how to build your own business. There are so many different ways for you to invest your money, and this is where financial education becomes so important. That way you can capitalize on opportunities instead of being the person that's just paying the price.